Good morning, everybody, and welcome to BDO's webinar focused on professional service firms. My name is Anna Jarrell, and I am the tax partner leading our professional services tax team in the UK. For those of you who don't already know, BDO is a global accounting network with over $9 billion in revenues, providing accounting, auditing and taxation services in 162 countries with over 80,000 people. Our speaker today is Jacqui Roberts. Jacqui is an experienced employment tax advisor who I work with along with the rest of the team on many compliance and advisory projects. Clients range across all the subsectors, including legal, recruitment, consulting and property advisory. You can ask questions during the webinar, and please use the Q&A feature which is in the top right-hand corner of your screen. We will address as many of the questions as we can at the end of the webinar, or if time does not permit, after the webinar. We're also recording, and we'll email you the slide deck as well as the link to the recording in a few days. We will finish within the hour. I will now hand over to Jacqui.
Thank you, Anna. So on the agenda today, we will be covering the off-payroll working in the private sector. There will also be termination payments and other topical matters, and then obviously the Q&A at the end. So the first topic is off-payroll working. And the changes to the IR35 rules with effect from April 2020. For the uninitiated, the original IR35 legislation was introduced in the year 2000 to tackle the perceived non-compliance of pay-as-you-earn and national insurance relating to pseudo-employees operating through an intermediary. In most cases, the intermediary would be a personal service company, PSC for short when going through this webinar, or perhaps an LLP. The PSC was required to assess whether an engagement between an engager and the PSC would be one of employment, but for the existence of the PSC. So where the assessment was one of employment, there was a deemed employment, and the PSC would need to operate pay-as-you-earn and national insurance on payments made by the engager to the PSC. HMRC have stated that although the old IR35 rules have been in place for 19 years, only 10% of those PSCs that should operate pay-as-you-earn and national insurance do so. With a lack of HMRC resources to enforce the rules, the government has now sought to shift the obligation of the PSC to the end engager in most cases. The first stage of the shift in obligations took place in 2017 for engagements where the end engager was a public body. And now with effect from April 2020, this is going to be extended to the private sector. When going through this part of the webinar, we'll be concentrating on the public sector first because that's where the rules started, and then the changes that will be coming in for April 2020. But before we go there, we'll just have a look at the current IR35 rules. I'm going to quickly recap on those. From an engager's point of view, the pay-as-you-earn and national insurance obligation remain with the PSC as long as the contractual arrangements are robust. So for a contractual arrangement to be robust, the following needs to be evidenced. There must be a contract between the engager and the PSC. Please note it is important that the contract is not a tri-party contract involving the worker. If this is the case, then IR35 is not in point, and the engager must consider their obligations under pay-as-you-earn. We've recently noticed more of a trend to use tri-party arrangements, and unfortunately the type of contract renders the contract invalid for IR35 purposes, in which case, instead of the PSC being responsible for pay-as-you-earn and national insurance, the end engager would be. So the second one is that the PSC must be incorporated in the UK. We would always recommend that Companies House is checked to confirm this. Where an overseas personal service company is engaged, there's a high risk that HMRC would seek any pay-as-you-earn and national insurance from the engager. The PSE should issue an invoice for fees, including any disbursement costs. And finally, all payments made to the engager should be paid direct to a UK bank account of the PSE. We often see cases where the engager reimburses expenses directly to the worker, and this can render the contract invalid. Where all of the criteria are in place, HMRC are likely to pursue pay-as-you-earn and national insurance from the PSE and not the end engager. Remember that IR35 also includes executive and non-executive directors providing their services via a PSE. A director is an office holder, and remuneration paid to an office holder for office holder duties will be subject to PAYE and national insurance. In the past, HMRC challenged and sought pay-as-you-earn and national insurance from engagers where a robust contractual arrangement was in place, because the director was registered personally at Companies House. HMRC's view that the personal appointment at Companies House invalidated the company-to-company contractual arrangement, and they would seek pay-as-you-earn and national insurance on this basis. However, the approach by HMRC has always been inconsistent in this area, and some inspectors would have accepted IR35 applies, regardless of the personal appointment. HMRC's own guidance now indicates that they expect pay-as-you-earn and national insurance to be sought via IR35 by the PSE. Some good news there. That said, HMRC stated that where the arrangement is set up for the avoidance of pay-as-you-earn and national insurance, they still reserve the right to challenge that pay-as-you-earn and national insurance should be sought from the engager. Although not seen all the time, where a worker has a controlling interest in an end engager company and operates via a personal service company, IR35 is again not relevant, leaving the engager to operate pay-as-you-earn and national insurance. From the engager's point of view, employer compliance is not only essential for mitigating pay-as-you-earn and national insurance risks for a business, it's also essential for CCO and SAO purposes. Corporate criminal offence requires companies to have reasonable procedures in place to demonstrate a defence against the legislation. This means if an associated person of a company criminally facilitates tax evasion and the company is unable to demonstrate that it has taken reasonable procedures in place to prevent that, the business is guilty of a criminal offence. An associated person, for the purposes, is widely defined and could include clients, customers, employees, agents and contractors. It is therefore essential for you to understand your chains of supply, which involve entities such as PSEs, agency umbrellas, and implement procedures to mitigate these risks. As we mentioned previously, the position for workers providing services to public sector organisations through a limited company changed with effect from April 17. While I will not be going into the finer detail of these rules, it's important to remember that they only relate to the public sector, which in this context is organisations subject to the Freedom of Information Act and therefore includes central, local and extended branches of the government such as the NHS and BBC. But it's also remember that these rules are the rules that are going to be slightly changed for the private sector. It's also important to understand the key principles underpinning these changes, as this is in essence being rolled out in April 2020. So, since April 17, where an individual has personally performed or is under an obligation to personally perform services for a public body in this instance, and the services are provided not under a contract directly with the client and the worker, but under an arrangement involving a third party, more often than not a PSE, and the circumstances are such that these services were provided under a contract directly between the client and the worker will be treated as an employee of the public sector organisation, pay-as-you-earn and national insurance must be operated on the payments for the worker's services by the fee payer. and i.e. the fee payer is the entity paying the personal service company in the contractual supply chain. The obligation to operate pay-as-you-earn, where due, falls on the fee payer. And the fee payer is the public body if they engage with a third party, in other words, paying the PSC directly and there isn't an entity in the middle. If, however, there is an intermediary paying the third party, such as an agency, as part of a labour supply chain between the public body and the third party, then the fee payer will be the intermediary paying the PSC, which may not necessarily be the agency with which the public body directly engaged. Public sector changes are being used as the basis for further extension of the off-payroll working legislation to the private sector and third sectors. They give us some useful experience and pointers for the future. Firstly, and in contradiction to the legislation, a number of workers were deemed to be employees on a blanket basis. Individual assessments are actually a necessity, and it is possible that the time pressures that led to some of these blanket assessments previously show that there was a key for preparedness in the future, because blanket assessments will not be possible. Empirically, we understand some of the decisions taken to determine a worker was inside IR35 was as a result of political pressure from elsewhere in the public sector and or the civil service. It's expected that the private sector in particular will not be as susceptible to these pressures and will take a more pragmatic approach to making the determinations. Thirdly, there was significant confusion around outsource agreements and composite supply arrangements, whereby a business providing workers to a public sector did so as part of a wider agreement covering other matters such as equipment. Unhelpfully, the HMRC guidance on this arrangements, whether they were caught, and if so, whether the supply chain, the obligation fell away. While high-level examples have been given as part of guidance for the public sector, from conversations we have had with HMRC, it's been indicated that more comprehensive guidance will reappear, having been updated to reflect the legislative changes. In fact, we have had some guidance through fairly recently. At the moment, unfortunately, it doesn't seem to provide much colour to the guidance. It just purely repeats the legislation that's been provided at the moment. There were also cost pressures on end engagers. The addition of employers' national insurance and, where appropriate, the apprentice levy increased the cost of engaging the worker, as well as often squeezing agency margins. Where these costs fell and the ability to pass them on was not a matter of commercial negotiation and reviewing contractual arrangements, thus further demonstrating these changes go beyond tax and encompass legal, resourcing, procurement issues too. So let's move on to the private sector. The draft legislation was published on the 11th of July this year. It's important to note that this is draft legislation and therefore our webinar is based on this alone. The legislation still has to go through the scrutiny of parliamentary houses before receiving royal assent. However, if the draft legislation stays as it is, we will be expecting the private sector rules broadly to mirror the public body rules. However, there are some significant differences, all of which will place additional responsibilities on the end engager. The first challenge is that the end engager is to communicate the conclusions of the status determination to the worker's PSC in addition to the next one in the chain. So previously there was only the communication to the entity next in the chain from the end engager, and now it has to be to the end engager and the worker. This makes sense, as previously the PSC had no knowledge of the status determination that had been made, until they receive their fees net of pay-as-you-earn and national insurance, allowing no time to discuss any potential disagreement with the conclusion reached by the end engager. Again, reasonable care must be demonstrated. HMRC will not accept the blanket approach to all individuals providing similar services. Although reasonable care is not defined in the new legislation, the subject has been heavily tested in courts, which is worth bearing in mind. The second change is that in addition to communicating the status determination to the PSC, the engager must explain the reasons for its conclusion. Currently, we do not know what the rules are expecting this to look like, but the legislation refers to the document as a Status Determination Statement, or SDS for short. Also, what is of particular note is that the SDS must be issued where it is concluded that the conclusion is one of self-employment or of deemed employment and the reason why. So not just in cases where the individual is deemed to be an employee, but also those when they're not deemed to be an employee. It would be reasonable to assume that this is so HMRC has a clear audit trail of the communications made if there are any changes or challenges at a later date. The third change is the end engager must also implement a process to manage and deal with any disagreements received, expected to be from the worker's PSE or the fee payer, but it could be from any party in the chain. There will be a time frame for dealing with this process. The end engager must, within 45 days from receipt of a disagreement, either inform the worker, the fee payer who's relevant, that it has considered the representations made and has decided that the conclusion is correct, i.e. the original statement of deemed employment still stands, and reasons why must also be provided. Or give the worker and the fee payer a new SDS which contains a different conclusion and states that the previous SDS is withdrawn and why, i.e. the worker is no longer a deemed employee. Where the end engager fails to meet the 45-day deadline, the end engager becomes the fee payer with the pay-as-you-earn and national insurance obligations. The final change is to exempt end engagers classified as small. For a company, an LLP, and an LLP, this is based on the definition in Companies Act 2006, as determined in the financial year ending in the previous tax year to the year in question that we are looking at. So let's take a look at a diagram to help explain all these complicated rules. If we look at the top diagram, this shows a straightforward contractual chain between a client and a PSC. Therefore, in this case, the client is the end engager and the fee payer. A status determination needs to be made by the end engager. Let's assume that the conclusion is one of employment. The client will add the individual to the payroll as a deemed employee for any pay period after April 2020. The worker will be treated as having a second employment with that client. Pay-as-you-earn national insurance will be deducted from the net of VAT amount detailed on the invoice. Employers' national insurance and apprenticeship levy would also need to be accounted for. But any pension, auto-enrolment or employer-paid statutory benefits remain with the obligation of the PSE, as the PSE is the worker's primary employer. The bottom diagram demonstrates the rules in a more complex scenario and probably more typical. In this example, we have an end engager, an entity the end engager contracts with, as well as the PSE and the worker. Agencies listening will no doubt recognise that they are never the end engager, but more likely to be the entity closest to the end engager, or even further down the supply chain. In our scenario, the agency is closest to the PSE, and therefore the agency is the fee payer. The end engager will issue a SDS to the worker and the next one in the chain. Let's assume this time that the worker is genuinely self-employed. So the end engager informs the agency that the SDS is one of self-employment and the reasons why, and no further action is necessary. So what if the client is the entity between the PSE and the end engager, and not a temporary supplier of workers, such as a consultancy company providing professional services? The question here is, who is the end engager, and who is the worker providing their services to? Is it the professional services firm itself, or is it the end engager? We have come across many cases with our clients where this answer is not clear-cut. The end engager may be providing a holistic consultancy service or outsourced services. When establishing who has the pay-as-you-earn and national insurance obligations, it's necessary to identify the entity receiving the personal services of the worker. It may therefore be necessary to drill down into more detail to understand the engagements and the work in practice, and understand the worker's involvement in providing those services. We recommend those listening that recognise this scenario and unsure should seek further employment advice. When the public body rules were implemented, it was recognised that the NHS outsources many of its departments, and so helpfully the majority of NHS public bodies that outsource services are exempt from the public body rules. Hopefully, HMRC will recognise that in the private sector there are a myriad of advisory outsourced services and provide some clarity in the anticipated guidance. Just a quick cap on the liabilities. So, as with all tax reforms, in order to encourage compliant behaviours and identify deliberate non-compliance, there are punishments for failure to operate. As already explained, it is the engager's duty to inform the worker and the fee payer if they fall within IR35. Until such time as the determination is communicated, that pay-as-you-earn and national insurance liability remains with the end engager. This means that if pay-as-you-earn and national insurance is due and the end engager does not deduct pay-as-you-earn and national insurance or apprenticeship levy, plus report to HMRC through the RTI mechanism as if the worker was a direct employee, the standard late pay-as-you-earn payment surcharges and RTI incorrect and late filing penalties would apply as if the payroll was not operated correctly for a direct employee. These penalties include late filing penalties of £100 per month per 50 employees and late payment surcharges of up to 4% of the total pay-as-you-earn and national insurance due. Similarly, that liability to operate and report pay-as-you-earn and national insurance can only be passed on if that decision is made in good faith and based on a reasonable assessment of the facts. A lack of due care and attention in making the assessment will result in the liability remaining with the end engager. Of course, if pay-as-you-earn and national insurance liability is passed to the fee payer, they would assume the employer payment and reporting responsibilities. And if pay-as-you-earn and national insurance is due but not paid or reported, the standard late pay-as-you-earn payment and filing penalties will apply to the fee payer. One further factor is where the liability has been transferred along the supply chain, but there is a compliance failure. Where a labour supply chain was involved in the public sector reforms in 2017, it introduced the concept of a chain payment, the payment of which pay-as-you-earn and national insurance is due on when the obligation is passed along the supply chain. The new legislation develops this concept and grants HMRC powers to transfer the liability up the chain where the pay-as-you-earn is not operated on that chain payment. Finer points of these powers have not yet been confirmed, but in responses to the consultation document, it was indicated that the intention was that the buck stops with the fee payer rather than the end engager, except in extreme cases. The exact details of the debt transfer powers are to be published as part of HMRC's guidance, but again, as in the consultation responses, HMRC have indicated they will only transfer the debt in cases of deliberate default or situations involving tax avoidance. The problem with this is that this is their guidance of how they have said that they are going to operate, but currently the draft legislation doesn't match this. Regardless of how the debt transfer powers do manifest themselves, one key takeaway is that the end engager must know who is in their supply chain and only be performing supply chain due diligence. As mentioned, due diligence is also a requirement of the wider tax obligations, such as those under the SAO regime and the CCO, of the failure to prevent the facilitation of tax evasion. While April 2020 may seem a while off, preparation should already be underway to assess the impact of these reforms. As discussed earlier, from the public sector changes, they demonstrate failures resulting from a lack of preparation. One of the key themes in the consultation feedback was that the organisations need time to ensure that the functions, policies and procedures for all of finance, tax, HR, legal, procurement and resourcing are well prepared and ready. In particular, organisations need to identify the engagement of workers through personal service companies in their supply chain. This should be part of a wider supply chain review because, as we've already said, the obligations already exist in the wider corporate tax regime that need to be fulfilled. Where off-payroll workers supplying services to the end engager in a personal capacity are identified, there is a need to carry out the status determinations to identify whose engagements would be caught or potentially caught by the new legislation. There will be need a commercial assessment on both the engagement of those workers going forward, but also the appropriateness of the engagement of workers through PSEs generally. As necessarily required, the working relationship and contractual agreements may also need amending. This review should fit within a wider appraisal and update of current approaches, policies and procedures. In particular, organisations should be looking to dovetail their off-payroll labour engagement processes with their wider company governance obligations. So that's the off-payroll working in the private sector, a very complex area, and if you have any questions, please feel free to send those in, and we will move on to the slight changes in termination payments. So more changes that employers have to consider relate to the termination payments. In April 2018, the legislation was brought in to ensure that amounts reflecting pay for a notice period, whether labelled as such or not, became chargeable to pay-as-you-earn and national insurance. So that was one change. With effect from April 2020, legislation will be published to ensure that any payment in connection with a termination payment in excess of the $30,000 will not only be subject to pay-as-you-earn, as is the case, but also a national insurance charge. And this charge will be Class 1A national insurance. This will be an employer-only national insurance charge, as there appears to be no intention for us to need to account for the corresponding employee's national insurance. The pay-as-you-earn is obviously deducted by way of the payroll mechanism. However, Class 1A is not deducted by the payroll ordinarily. Class 1A is paid by the employer as an annual charge on company-provided non-cash benefits, which are reported on the P11Ds, such as company cars, critical illness insurance, medical insurance. Currently, there's no further indication from HMRC as to exactly how we're going to collect the Class 1A national insurance on these termination payments. A quick example to help explain the new rules are as follows. Let's assume an employee is to receive a termination package of $51,000. The $51,000 comprises of statutory redundancy pay of $3,000, enhanced redundancy pay of $28,000 as per the employer's redundancy policy. The employee was entitled to $20,000 in respect of the notice period not worked, and finally $10,000 as compensation for loss of office. So in this case, the termination payment is $3,000 plus $28,000 plus the $10,000. So we ignore the payment for the notice period because that's already subject to PAYE and national insurance as previously explained. Then you've got $41,000 less the $30,000 that is applied to a genuine termination payment, and the excess of the $11,000 is now subject to pay as you earn and Class 1A national insurance. So finally, moving on to a couple of other topics. We have pay-as-you-earn settlement agreements, and we're going to have a quick look at some internationally mobile worker issues. So, pay-as-you-earn settlement agreements. As a recap, this is an annual agreement whereby an employer can agree with HMRC via a contract that the employer will settle the tax and national insurance due on employee benefits. This is useful for costs that are often provided to employees which you wouldn't want your employees to pay tax on. A good example being staff entertainment, and then others may be things like taxable travel expenses, maybe broadband that's used for the business, and non-qualifying relocation expenses and benefits. The costs in a PSA must be minor, irregular, or impracticable for pay-as-you-earn to be included. Note that this is an or test, not an and test. For those with PSA contracts in place for 2018-19, the tax and national insurance computed must be agreed with HMRC and paid over by the 22nd of October. The common mistake here is to forget that VAT must be included regardless of whether the VAT is recoverable or not. It's also worth ensuring that all applicable exemptions have been used to mitigate the tax and national insurance due, and examples being trivial benefit exemption and the canteen exemption. So, our internationally mobile employees. Firstly, we'll look at the short-term visitors. For those group structures with overseas entities and branches, this is a continued area of compliance focus for HMRC. Long gone are the days of a relaxed attitude by HMRC. Now, if a short-term business visitor comes to the UK, and for the benefit of the UK, in the absence of any agreement to the contrary, the employer must operate pay-as-you-earn and potentially national insurance from day one on a proportion of the salary paid to the overseas group employee visiting the UK. HMRC are keen to investigate how companies track their overseas colleagues visiting the UK, and in the event of a lack of tracking, have been known to become fairly intrusive. For instance, they could demand copies of travel logs, expense sheets, hotel flight booking costs, etc., ultimately to raise an assessment based on their assumptions of any unpaid pay-as-you-earn. For those visitors from a country with which there is an appropriate double taxation treaty, It is possible for an employer to seek agreement that pay-as-you-earn is not due in certain circumstances, i.e. where pay-as-you-earn would not arise usually, and that's usually for visits up to 90 days. The mechanism is known as a short-term business visitor agreement. In instances where pay-as-you-earn is relevant, it is possible to reach an agreement with HMRC that the payroll for such employees is operated only on an annual basis. This may be well suited to employees travelling from an overseas branch when pay-as-you-earn is always due. So, a little on non-resident directors. Where UK non-resident directors come to the UK, pay-as-you-earn and, I hasten, national insurance sometimes are likely to be due, even if remuneration is paid outside the UK. And unfortunately, the administrative implications afforded by the short-term business visitor agreement or the annual payroll scheme do not apply to directors' board duties. For this reason, we would recommend that all companies watch out for any non-resident directors performing duties in the UK. And finally, just a little bit on Brexit and the implications for mobile employees. At the present time, whilst the UK is a member of the EU, we have the following arrangements for employees and self-employed actually. All workers are only liable to social security in one member state, one EU member state. This is usually the state in which they work, but they can remain in their home system in some situations, e.g. if they are posted overseas for up to 5 years if they obtain an A1 certificate. Also, workers with separate jobs in more than one member state, for example, would usually pay social security in their home location, subject to some conditions being met. HMRC has published advice on the implications of a no-deal Brexit, and the government has also made various regulations allowing for changes in the social security regulations to take place in case of a no-deal Brexit. Whilst there are some, it would appear that it's the case of a no-deal Brexit, you could have the following in position. The UK continues to accept, at least for an interim period, that the EU-based employees and self-employed are covered, or individuals working in the UK remain subject to EU regulations and not liable to national insurance. And UK-based employees working in the EU on assignments after a hard Brexit could become liable to double contributions, i.e. both contributions in the UK and the overseas social security system. In some cases, other EU countries may not impose host country social security on secondees from the UK because there is a historical social security agreement between the UK and the country concerned, which in effect becomes reactivated in the case of a Brexit. Or the other jurisdiction may relax its domestic social security regulations for an interim period prior to the date of a hard Brexit. The EU has recommended that the member states should show some flexibility in this regard, although when the UK becomes a third country, international social security agreements are not in the area that the EU has any direct or informal involvement and oversight over. On a more positive note, the government has, however, been able to reach some new agreements with both Ireland and Switzerland from a social security perspective. Both of these new agreements will come into effect in the case of a Brexit. It's fair to say that, in summary, there are a lot of open questions and a way to go before we have the clarity we need. Thank you for listening. I'll pass you back to Anna for general observations and any questions that you may have had asked during the webinar.
Thank you very much, Jacqui. I thought we might get through the whole presentation without talking about Brexit. We didn't quite make it, understandably so, given what's going on. Okay, so there are a couple of questions. I think before we start on that, the general observation around the changes in the off-payroll workers world is complex actually are known in some cases in terms of, as you mentioned, about the guidance.
Yes.
So I think, as you say, the approach is around understanding what position our clients are in, so for them to have a trawl around what it is or who it is that they're actually employing or engaging with, in order to be ready to apply the rules as we properly understand them when they're finalised.
Yeah.
Okay, so some specific questions. A couple that I think you've already covered, but maybe it would be useful just to have a recap as well. So what happens if the engager fails to spot a personal service company in a supply chain and therefore PAYE and national insurance becomes due in the event?
Yeah. So essentially, the engager is the first entity in the chain that has the obligations, and where they haven't taken reasonable care and haven't even identified the personal service company in the first place, they won't have made an SDS assessment, and they won't have passed on any detail down the chain to the next one or the worker. Unfortunately, any payroll and national insurance liability that's not paid could ultimately become the end engager's obligation.
Right, okay, so we've really got to look out for that.
Yes.
Okay, so a specific one actually around a particular situation, which is where, for example, a contractor may work up until the end of April.
Yep.
Finishes in, end of March, so finishes in March, so i.e. before the new rules kick in, but is actually paid for the services after the start of the new arrangements. And it may be that we don't know about this yet because it's not been covered off, but would the new legislation apply on this payment?
That's a very interesting question. Always the difficult one's always interesting. So the legislation is based on the engagement, and that is the contractual engagement, so the contract that was in place for that work, which was before April 2020. However, in that instance, the payment is being made post-April 2020, and although I'm not definite, I suspect the new rules will have to apply.
Yeah.
I'd like to come back on that one, and maybe we can send something out to people afterwards.
Yeah, no, that's fine. I think all of these sorts of things are really quite tricky.
Indeed.
Okay, so a further one. So sometimes people provide their services via LLPs. So when could an LLP be classified as a personal service company?
Yeah, so an LLP, as per legislation, is a body corporate, and therefore it falls under the same definition as a personal service company. That wasn't actually covered in the presentation either. So a personal service company is a company in which the individual, excuse me, is working and providing services, and that individual owns 5% or more of their company. So if an individual as a member is entitled to 5% or more of the profits, that would also be a personal service company. So the LLP would be defined as a personal service company.
Yeah, okay. So you can't escape unless you're small, by the definition of the Company Act.
Yes.
Which I know are many employers, but not necessarily the majority of the people listening here, which is where the focus will end up being, of course.
Yeah.
There's more of an employment legal question, so feel free to sort of pass over this one, but I'll ask you just in case you know. If we do bring a personal services company into our in-house payroll to do the thing that we're talking about, deducting PAYE and national insurance, are we then required to provide other employment benefits? Or can we contractually agree their day rate includes all of the other benefits? So in other words, does it sort of mean that everything else has to be in line?
So these rules, if you become an employee, they are only as a deemed employee for tax purposes. It does mean that when the employee is on the payroll, because they're on the payroll, they are subject to the apprenticeship levy and the employer's national insurance. But for all other intents and purposes, they are not actually an employee for employment law purposes. That said, they may well, their circumstances may mean that they are an employee, but I'm not touching on that. These rules are for tax purposes only.
Right. So there's a real distinction there, and you've really got to think about whether they're actually a real employee or just a deemed employee for this purpose. I can see why you need to take advice on this.
Indeed.
Okay. So a further one on the off-payroll workers is to do with a non-exec piece. Obviously, we have examples where people have non-execs on their boards, but they are often providing services to a number of different clients from their perspective. So in that case, where I've got a non-exec on my board and I'm paying that non-exec through their personal service company, is this caught by RR35 currently, and will the new rules change that?
So if we are talking about duties that are performed by a non-executive director, i.e. the board duties and the preparation for board duties, those are the role of an office holder. And an office holder is subject to PAYE and national insurance. And in fact, that was clarified several years ago that when you're looking at IR35, a non-executive director in that position would be subject to PAYE and national insurance, which ultimately means PSCs that have NED services within them should be subject to PAYE and national insurance now. And it therefore means that when we move over to this new system of the obligations being transferred across to the engager or the fee payer, again, any services provided by NED, the board duties, would be subject to PAYE and NIC. That said, some NEDs do provide, or the majority I would say, NEDs do provide consultancy services as well. So what I would be saying is there needs to be clear delineation between those two sets of services, possibly in two different contracts. One is for the NED services, which are subject to PAYE and national insurance, and the other one for the consultancy services, as long as it's structured in such a way that it is for genuine self-employed consultancy services.
Okay. A non-off-payroll working question.
Oh.
So you mentioned trivial benefits earlier.
Yeah.
What is a trivial benefit? So how do I see one, if there is one there to be taken notice of?
So a trivial benefit is a benefit that is provided to an employee but not in any contractual nature, and probably not detailed in any policy documents, because that wouldn't necessarily make it contractual, but it would be something that the employee would be expecting. And it must be less than £50 for whatever is being provided, and it can't be cash or a cash voucher or in any way involved in any kind of salary sacrifice arrangement. So essentially, if all employees were provided with, let's say, some ad hoc cakes in the office, and overall that cost less than £50 per head in a year, that could be classed as a trivial benefit. So that's why you would want to have a look at the detail around that trivial benefit and apply that to any cost in your pay-as-you-earn assessment agreement, which may have had tax and national insurance deducted in the past. So there's possibly refund situations as well.
Yeah, because those trivial benefits don't attract tax and national insurance.
Yes.
Okay. In terms of the practicalities around some of this stuff, and this is another payroll, off-payroll question, you talked about the status determination statement. How do clients actually go about determining whether or not, or what should actually go in that status determination statement?
Yeah, we have no guidance on this at the moment. It just the guidance that we have received purely says you need to make an SDS. Very helpful. So I guess if you think about what it's asking for you to firstly, before you get to an SDS, you need to make sure that the company is a personal service company, as we've discussed with the definition. And then if we have a personal service company, It's a written communication to the worker and any entity next in the chain that they're caught for IR35 and why. Now we have got HMRC's assessed tool, that's what it's known as, which assesses employment status. Whether it's fit for purpose is questionable. It's still being looked at to see if they can improve it further, because HMRC recognise in some instances it doesn't necessarily do the job that it's expected to do. Or it might be that a company wants to think about implementing their own employment status tests and be comfortable with those because they fit the work pattern of the individuals in their company.
Okay. And the final question, again, which you may or may not know the answer of, or which we can follow up afterwards, is really around, again, an off-payroll worker question, is because there's going to be a shift, so a change in rules and also the change in emphasis of who's subject to the liability. So it's moving away, say, from the personal service company to our clients, as an example.
Yeah.
Would HMRC, do you think, start thinking, well, hang on a minute, our clients have started to pay payroll taxes on these payments. Should I start talking to the personal service company as to why they weren't necessarily paying over PAYE and national insurance prior to the change?
Well, that's a good question. So HMRC have actually stated that they have no intention to use the information that is going to be gleaned from obviously operating pay-as-you-earn on these payments from April 2020. They've said that they will not seek recovery of the past. Now, that said, I don't know if anyone read the Times a couple of days ago. There was a blanket letter sent out by HMRC to 1,500 pharma consultants in a very well-known pharma company, basically challenging that they weren't operating IR35 properly, and they've become aware of this, and they wanted the individuals in their personal service companies to either say that they were genuinely self-employed and why, or to disclose pay-as-you-earn and national insurance. So that's in the pharma sector. We've seen HMRC hit doctors and dentists. Who's next? HMRC have got, what have we got, 8 months. We could see some activity from them sending out more of these letters to personal service companies. Obviously, not necessarily our clients, but will be providing the services in the future. But that's where we are in terms of HMRC's approach to some individuals in personal service companies at the moment.
Yeah, so still interested in the area running up to April.
Yeah.
But clients have to do the right thing regardless, as you've mentioned, the FAO requirements and also the corporate criminal offence requirements as well. Okay, I think we've come to the end of our questions, so I want to say thank you very much, Jacqui, and there's quite a few at the end there, so unsurprisingly, given the complexity of the rules, and thank you all to our listeners. We will, as I've mentioned earlier, send out the slides and a recording in the next few days. Thank you very much.